potential knows no bounds. Raising the bar, breaking ground.
How you doing, ladies and gentlemen? Welcome to This and That. I'm your host, Xander, where we're talking about this, that, and everything in between. I'm glad to see you guys here tonight. I told y'all that we was going to start this Some Gun on Time one time this week. We got the internet going on a good momentum. So today we're going to be talking about the pros getting into the 7 golden rules of long-term success with their investments. So I want you guys to be able to bear with me today as we dive deep into the difference between positive short-term versus long-term investments and stocks, bonds, and other such things. You're going to love this. For those of you who wasn't sitting in some of the other business and finance podcasts that we've done, this one's got some details. I was like, whoo, grit. Most of it I haven't even covered before. So this is actually going to be a phenomenal show today. Make sure that you guys like and subscribe. Also join the membership. Show us some special things, special likes, special emojis. Support the podcast. Show us some love. We greatly appreciate it. It'll help us become a better podcast and get that extra high-speed internet so that we can kind of upgrade ourselves to that ultra 1080, 4K, high definition, just in your face kind of software. We working on small podcast, trying to get big. Show us that love, show us that support. We really appreciate y'all. Special shout out for those that are on Twitch and Twitter, as well as those that are watching us on YouTube. TikTok still banned, so we got to do what we got to do. So moving on, let's dive. And remember, for those of you that are popping in, we are live 7 nights a week. We're starting to tee it off at 10 o'clock Eastern, 9 Central, 6 Pacific. We're going to try to make it a regular thing, but we go live every night of the week. So even in the events that we don't start on time, we definitely get it done before the sun rises. So always take a look at the channel and see if a show aired, if you missed it, and go back and watch the show. So let's go ahead and get started on this investing. When it comes to investing, having a solid foundation of rules is crucial for achieving long-term financial success. Without a clear strategy, it's easy to get caught up in emotional decision-making, which often leads to impulsive buying and selling. This is exactly why so many investors struggle to achieve their financial goals. But what if I told you there's a better way? One of the most common mistakes novice investors make in jumping into the market without a clear understanding of their financial goals. In addition to that, they might invest in a hot stock without considering whether it aligns with their risk tolerance or investment horizons. For those of you that don't know what that is, your risk tolerance refers to an investor's ability and willingness to endure fluctuations in the value of their investments, the degree of variability in investment returns, and the investor is willing to withstand, and it encompasses both emotional and comfort with potential losses and the financial capacity to absorb those losses. Now, for anybody who didn't understand the words that just came out of my mouth, your risk tolerance is the ability to put your money into your stocks, leave it there, don't touch it, don't take it out. Go with the flow of the transactional trades and be able to handle if you lose a bunch of money or if the returns that you were hoping to get back were not as much as you had anticipated. An investment horizon refers to total length of time that an investor expects to hold a security or a portfolio before needing to access the funds. It is a crucial concept in investing because it helps determine the appropriate investment strategy, asset allocation, and level of risk that an investor can tolerate. Let's understand the difference in investment horizon terms. A short-term horizon is a duration typically less than a year. The investment options for this would be cash or cash equivalent investments, such as savings accounts, high interest checking accounts, like I told you guys before, money market accounts, short-term bonds. And those short-term bonds are 3-month bonds, 6-month bonds, 9-month bonds, stuff to that effect. Generally lower risk, as the focus is on preserving capital rather than seeking high returns. Short-term investors are more sensitive to market fluctuations. An intermediate term horizon has a duration usually spanning from 1 to 5 years. An investment option that has a mix of stocks and bonds that balances growth potential with moderate risk. This may include mutual funds or ETFs, and you have a risk profile that is a moderate risk, allowing for some exposure to equities while still maintaining a degree of stability through flexed income or fixed income investments. Now, the last one we're going to talk about is the one that the topic of the show is on today, using those 7 golden rules to experience and benefit from long-term horizons, which has a duration of more than 5 years, often extending to decades. When I told you guys about having a 10 to 20-year plan, your investment options are primarily equities, stocks, and stocks mutual funds or ETFs, as these have greater potential for long-term growth despite short-term volatility, and the risk profile be higher, much higher, and the tolerance is acceptable since the investor has time to recover from market downturns. Long-term investors can benefit from compounding returns and are typically less affected by short-term market fluctuations. The length of your investment horizon influences how much risk you should take. Longer horizons allow for more aggressive investments since there is time to recover from potential losses. Aligning your investment strategy with your financial goals is essential. For example, saving for a down payment on a house requires a different approach than investing for retirement. Your investment horizon guides the types of assets you should include in your portfolio. For instance, short-term goals might necessitate more conservative investments, while long-term goals can accommodate riskier assets. Man, you know what? I got to tell you something. 38 hours awake, vocabulary is rough right now. Reading and comprehension is up there, but articulating clearly is definitely becoming a struggle. Either way, the show must go on. I'm not going to fail you guys. I never have, never will. You're going to get this information the way you always get this information. So as your age or your financial situation changes, your investment horizon may shift. It's crucial to periodically review your goals and adjust your portfolio accordingly. This is also good advice for your relationships. It's always good periodically to reassess the goals of you and your partner in the relationship, and periodically make adjustments and adapt accordingly to the expectations of the parties involved in a relationship. Now, examples that you're going to utilize in your investment strategy, such as an approach to retirement. You may want to reduce exposure to high risk investments and increase holdings in more stable assets like bonds. Others might fall prey to getting rich quick schemes, hoping to make a quick profit without putting in the effort to educate themselves. Then there are those who try to time the market, thinking they can predict when to buy and sell based on emotions rather than facts. Those are the people who are going to buy into Bitcoin when Bitcoin's at 90 grand instead of buying into Bitcoin when Bitcoin was 40 grand. Then when Bitcoin hit 90 grand, instead of them selling before Bitcoin crossed over 91 grand, they would try to sit there and see if Bitcoin will rise to 100 grand. Then when Bitcoin tanks down to 60 grand, they would have lost 30 grand because they bought in at 90 grand instead of buying in at 40 grand, where they even on their worst day would have walked away with 20 grand. Now they're walking away with a negative 30 grand loss because they weren't doing what they were supposed to do. which is get in reasonably low, get out reasonably high, and then don't worry about the difference. And let's not forget about the countless investors who fail to diversify their portfolios, putting all their eggs in one basket. And then when that basket flops, all of your eggs are broken. When we invest without strategic approach, we open ourselves up to a world of potential pitfalls. We might get caught up in the hype surrounding a particular stock or asset class only to watch its value plummet. We might hold on to a losing investment for far too long, hoping it'll bounce back because it's already losing. We're hoping that we're going to get our money back. And it's just like putting 100,000 on black every time and it keeps hitting red. You're not going to get what you're looking for if you don't reassess your situation. We also might neglect to rebalance our portfolios, allowing our investments to drift away from our original goals. By avoiding these common mistakes, we can set ourselves up for long-term success. Now, what does it mean by your portfolio drifting away from your goals? You can have a certain type of stock that is supposed to generate a certain quantity of revenue in a certain period of time, and then you're supposed to relocate that revenue to another location where the revenue can incur more interest. For example, those high interest checking accounts that I told you about that draws back 5% interest on the first $500, but the second $200 is getting 0.064 or 0.057 interest rates, which is less than half of a penny per dollar, less than half of a penny per dollar. That's the percentage rate, which is horrible. Nevertheless, if you're not paying attention to your money, once you're capped out 500 grand, puts out any level of money in interest, that level of money is on a lower interest rate than your original principal. That's what they're talking about, is drifting away. If you were guaranteeing that 100% of your money was supposed to get a 5% interest and you're not paying attention to your portfolio, you're not paying attention to the fact that some of your money doesn't hit that interest spectrum, which means you have to relocate it if you're staying on top of your portfolio. So what are the 7 golden rules that can help us investing like a pro? Well, that's what we're about to dive into. From understanding our risk tolerance to diversifying our portfolios, each rule is designed to help us make more informed investment decisions. And by ending of this video, you will have a clear understanding of how to implement these rules in your own investment journey. Rule number 1. Understand your risk tolerance. Establish clear and achievable financial goals based on your personal circumstances and risk tolerance. This includes short-term, mid-term, and long-term objectives, which can guide your investment strategy and decisions. This might seem, obvious, but it's crucial to have a clear understanding of how much risk you're willing to take on. Are you comfortable with the possibility of losing some or all of your investment? Or do you need more conservative investments that provide a steady return? Knowing your risk tolerance will help you make informed investment decisions that align with your financial goals. Rule number 2 is set clear financial goals. What are you trying to achieve through your investments? Is it retirement, a down payment on a house, or a specific sum of money? Having clear goals will help you create a tailored investment strategy that's designed to meet these goals. Rule number 3, diversifying your portfolio. Spread your investments across various asset classes, such as stocks, bonds, real estate, Bitcoin, gold, and silver. Oil. Make sure that you get into oil as well to minimize your risk. Diversification helps protect your portfolio from significant losses in any single investment or sector. This is one of the most important rules, as it helps to minimize risk by spreading your investment across different asset classes. Now, That's also going to mean that if you find one investment opportunity that's got a 20% return, you might want to put some of the profits from that investment into a return. It might have 10 or 15% return. It might have a 5 to 8% return. But when your 20% return has a negative 15% loss and you're only making a 5% return off of it now, the fact that your other stocks that are making 10 to 15% return is going to blanket the loss of the 20% return, where you're not going to lose out on as much. So by diversifying your portfolio, you would be able to make sure that the quantity of money you was getting every month doesn't disappear, because the quantity of money that you're making on some of the other things the amount of money that you're losing. That is a healthy risk tolerance. By diversifying, you'll be less exposed to any one particular investment, which can help to reduce volatility and increase potential returns. Rule number 4, having long-term perspectives. Investing is a marathon, not a sprint. It is essential to have a time horizon of at least 5 years, and ideally 10 or more years would be preferable. This will give your investments time to ride out the market fluctuations and compound returns. Focus on long-term investment horizons, typically 5 to 10 years or more, and this will allow you to benefit from the compound returns and reduce the impact of short-term marketing volatility. As Warren Buffett's famously said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So I'm going to say that one more time, because I got to tell you, 38 hours in, it's a burnout. Warren Buffett said, if you ain't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Which I guess kind of really redirects your positive thinking on day trading, right? Rule number 5, keep the cost low. You really, before I keep going with that, you need to think about when you're investing into a stock, you need to find out the cost of investing, because there is an investment fee when you put your money down on a stock. There's a transactional fee. If there's a broker involved, the broker might get a fee. Then there's going to be another fee to sell the stock. So you're looking at the buy-in, the cost to buy in, and the cost to buy out. And that's just on the platform. And with there being so many investment platforms that you can download on your cell phone and start investing yourself and use the AI tools to help you with investments, you also have to understand that when you want to get real capital in your bank account that you can pull out of an ATM machine, you might have to take a few steps. You might have to wait a few weeks. You might actually have to withdraw the money out of the app, which may have a separate fee from the transactional buy-sell fees, and then you might have to transfer it to another location in order to get it to a bank where you could pull it out of the ATM machine before you pay taxes on it. So you got to keep the cost low. And when you're investing, you want to always invest enough money to make more money than you spent on putting it in, taking it out, and putting it back into your pocket. Always consider the margin of safety, which involves buying assets at prices significantly below their intrinsic value. And this principle helps to protect against unforeseen market downturns. Because if you bought an undervalued house and then the market collapses, the house is above value. The fees associated with vesting can eat into your return. So you don't want to have trade bots just trading for the sake of trading. You want them to trade where there's making more money than it costs for the trade. So it's essential to keep costs as low as possible and look for low cost index funds or ETFs and avoid high fee investment products. Number 6, stay informed, but avoid emotional decision making. Only invest in companies or sectors that you are knowledgeable about. This understanding helps you make informed decisions and reduce the likelihood of emotional or impulsive investing. Continuous education about investing, market trends, and economic changes is crucial for long-term success. Stay curious and open to new information to refine your strategies and adapt to evolving market conditions. Lord knows, y'all, they got me walking down the script. This is the hoo ha ha. Okay, so it is essential to stay up to date with market news and trends, but avoid making investment decisions based on emotions. Instead of focusing on facts and making decisions based on your own investment strategy and goals, you want to make sure that whatever decisions that you're making with your stocks has a purpose. Finally, rule number 7 is rebalance your portfolio regularly, periodically assessing your portfolio to ensure it aligns with your goals and risk tolerance. Market conditions change, and these regular reviews allow you to make necessary adjustments to stay on track. As your investments grow and change, it is essential to rebalance your portfolio to maintain your target asset allocations. This will help to ensure that your investments remain aligned with your financial goals and risk tolerance. But among these 7 golden rules, there's one that stands out as the most crucial, and that's having a long-term perspective. You see, most investors get caught up in the short-term noise of the market, worrying about daily fluctuations and headlines. But the truth is, investing is a long-term game. It's about creating wealth over decades, not months. And when we focus on the long term, we're able to ride out market downturns and capitalize on the natural growth of the market over time. For beginners, focusing on low cost index funds, ETFs, and mutual funds is often the best approach before diversifying into individual stocks or alternative investments. Index funds are mutual funds or ETFs that aim to replicate the performance of a specific market index, such as in S&P 500. They often they offer instant diversification, lower fees compared to the actively managed funds, and are ideal for beginners due to their passive management styles. Those are positive passive management style. Investing in an index fund allows you to invest in a broad range of companies without needing to pick individual stocks. Similar to the index funds, ETFs hold a collection of assets and trade like stocks on an exchange. They provide diversification and typically have a lower expense ratio than mutual funds. ETFs can be purchased for the price of one share, making them accessible for beginners. Many brokers now offer commission free trading for ETFs. Mutual fund pools for most multi investors to purchase a diversified portfolio of stock, bonds, or other securities. They are managed by professional portfolio managers. These guys can be good options for those who prefer a hands off approach. Look for low cost index mutual funds to minimize fees, and then also take advantage of robo advisors, who are automated platforms that can create and manage an investment portfolio based on your risk tolerance and goals. They will require minimum initial investment and charge lower fees than traditional functioning advisors. But this option is suitable for beginners who want to simple and easy way to start investing without needing extensive knowledge. You have your blue chip stocks that are of large size, well established companies with a history of reliable performance. These companies tend to be more stable and less volatile than smaller firms, making them a safer option for beginners looking to invest in individual stocks. Depending on stocks, you share in companies that return a portion of the profits to a shareholder for their form of dividends. Investing in dividend paying companies can provide a steady income that will stream while allowing for capital appreciation to overcome it. If you're hesitant about investing in the stock market, consider starting with a high yield savings account or certificates of deposit. These options provide safety and liquidity while earning interest on your savings, serving as a good starting point before venturing into riskier investments. These options provide diversification, lower risk, and ease of management, making these suitable starting points for building a successful investment portfolio. As you gain experience and confidence, you can explore more complex investment strategies tailored to your financial goals. Adhering to these golden rules can help investors build a robust portfolio that withstands market fluctuations while promoting long-term financial growth. And by focusing on strategies, diversifying investments, setting realistic goals, and committing to continuous learning, investors can navigate the complexities of the financial markets more effectively. Remember, it's not about making a quick profit or timed market strategy. It's about creating a solid foundation for your investment that will serve you for years. Now, if you've got your own investment experiences or tips, please leave them in the comments below. Thank you for watching the show. What we're going to be talking about coming soon is which of the 7 golden rules resonated with you the most. I want you to be able to put those comments into the show. Then don't forget to subscribe for more insight and content on investing, and make sure that you join the membership. For those of you that are on Twitch and or Twitter, make sure you hit the follow button. That way you can get notifications and updates as to when we go live on the podcast. Now, y'all are going to learn that by the time this is over, I will have convinced you guys to do as much as possible about getting your stuff together. But until we get there, first person accountability is that I need to make sure that I tell you guys what you guys need to know so that y'all can be successful, so that we can all be successful together. Now, that is going to be the pen that we're going to use to hold down the needle stack of hay, and we're going to go ahead and wrap this up. So, ladies, as long as the situation doesn't make sense, I'm going to keep asking you to keep make it make sense. So, lady, please make it make sense. And fellas, I really appreciate y'all coming to the podcast, because y'all make us who we are, and you guys are very supportive, so we really appreciate that. And I want to thank you guys for coming to This and That, where we talk about this, that, and everything in between. I'm your host, Sander. Special shout out to Red Void. Special shout out to Liberty Twisher, Silly Emma, Jake, Justin, and the guys over on Twitter. I really appreciate you guys coming to the show. And I'm going to see you guys tomorrow night, probably closer to an hour from now, because I kind of noticed that the fluctuations didn't fluctuate the way I wanted them to fluctuate. Either way, we're going to make this make sense, and we're going to make it work. And once we get it to where we want it to be, you're going to see so much more improvement on the podcast. So if you're missing it as you're diving in right now, make sure that you go back and look at it from the beginning. Again, I'm your host, Sander, with This and That, where we talk about this, that, and everything in between. And I'm going to see you guys tomorrow.